Hello, TradingView back again for second video of the morning. Okay, yeah, I'm really churning them out, right? Um, yeah, so I'm gonna actually wanted to bring up stocks and stinky stoink market. Just because I had actually a little interesting personal event story that went on in the last few days regarding a personal friend of mine. Yeah, I'll get into that in a minute, but I just wanted to show you the power of just having a long-term uh, savings vehicle, which would be if you're still working in the States, the US stock market, right? Um, you're getting paid free money in normal companies. If you put up a little, couple $100 every paycheck, there's an employee match going on. I don't know what it is, but it's around 5%, I believe. I think it even gets up to like 8, 9% if you're like a supervisor. So 8% of your salary, if you're making 100 grand a year, that's 8 grand free, tax-free money on top of a match you're putting in. That's 16 grand. All right, 16 grand a year over 20 years. That's 320,000, right? 320,000. And you know, if you look up the annual returns of the US stock market, there's plenty of years where it does over 20. I mean, over 20% a year, it's done that quite a few times. Sure, we have um, our crashes, quote unquote, but these are actually just a version to a mean of creating just basically a higher floor, right? So look, this chart of the spiders goes back to 94, and also shows you power of ETF, a low cost vehicle for wealth to accumulate in, right? Before that, you would have to rely on a fund manager or investment brokerage to give you tips, or a someone to manage it for you, like Peter Lynch, for example. He was always a famous guy back in the 80s. But just having a spy just do all the work for you is powerful, because now they may only charge you 0.5% or 1% a year for the creation and management of this fund, because I think they rebalance, right? They do some rebalancing along to match the actual S&P 500. So I'm sure actually that does not involve much work, but there's some administration going on, and there's offices to rent, etc., etc. And obviously they want to get paid for their efforts. So no problem with that per se. But a 1% commission per year, yeah, that's eating into your returns, right? So what did I want to highlight? So yeah, created 1993, and okay, so basically took a year and a half for acceptance of an ETF, because I remember back in the day, ETFs were kind of frowned upon. It was like, huh? Why would you want to do that? Why not just pick stocks yourself, or give it to somebody that's got a track record? But no, actually, just plugging your money every month or every 2 weeks in your paycheck into something like this was the way to do it, right? Um, you know, people pass, people die, get sick, or lose their edge or way. So rather than trust in humans, have something that's like programmed to pump, right? And that is US companies. They are programmed to pump because they get free money essentially from the Fed, indirectly or directly, but they get free money, right? And so, so look at this. After the creation and after the general acceptance, I'm sure there was some behind the scenes things going on. Maybe they didn't really push the marketing until 94, 95. But I think this was actually a driver for this market, along with the story behind the text. Having something like this uh, actually gave the market oomph, and I think it also played out in the GLD when that got launched in the early 2000s. That also provided gold push, an easy vehicle to acquire exposure, right? So I'm in crypto, and we get a lot of fun news about why having a Bitcoin ETF will be bad. It's not your keys, not your crypto, etc. But if you want to see higher prices, having a Bitcoin ETF is uh, needed. Is needed, right? If you want to get up to like $1 million at some point this decade, the ETF will do it. It won't be people like being learning technical computer skills to manage your crypto. It's basically having a one-click solution to get exposure, right? And so let's go back to the 90s because I remember it quite vividly, even though it's nearly 30 years now, right? So I was only a kid. I was still in school, but I was always interested about the money markets, the markets in general. So I actually do remember Alan Greenspan and his infamous rational exuberance utterance, which I think it was around here. Somebody could look it up, but I think it was middle of '96, and he may have caused this little dump, you know. Um, so he may have caused a dump, and then he also may have said, no, yeah, maybe let's just keep rates zero or something, or low, to give the fuel for the market." So uh, Federal Reserve interference in the market is kind of weird, right? I don't think that should be a role they're conservative. It shouldn't be the case. Anyway, all this time there's actually lots of fun, lots of fear, lots of uncertainty, lots of doubt, but it hadn't zero effect on the price performance because we had. I think this is long-term capital. No, it's in '98. Yeah, that could be long-term capital blowing up. I think '97 had Asian contagion, right? So this is back in when something going on in Japan or Korea or where have you didn't really have an effect on US markets because people were more disconnected back then. Countries were countries, borders were borders, and global communications are not like it are today. Um we also had the Russian bond crisis, Russia blowing up, right? Their debt markets. So long-term capital blowing up, Russia blowing up, the Asian contagion. Yeah, but still prices just kept on marching higher. Um, so what did I want to really highlight? Just yeah, long-term investing, right? It's going to pay you. If you're getting free money, just max it out. What was that number again? 320,000 over a 20-year career. Now you start adding positive returns on that and reinvested. I can see turning this 320 into like 3.2 million easy. All right. Um, I could do the math and make a comment on this video later and see if it's true. But yeah. So back to this personal story of mine. It's actually kind of funny. So when the '08 crisis happened, the GFC, the mortgage meltdown, I was still in my 20s. But actually, I was actually playing the gold market here. I was playing the mining stocks, the Gold Corps, the Newmonts, and the Silver Wheatons, all the big guys, right? But I was playing with the options, and just putting a few grand in there, here and there. And I remember, was it '07? No, it was in the summer of '08. Yeah, I remember the housing topped in February 2000. That was the key. There was a little tremor going on, so the warning signs were already there. I remember Bear Stearns also running into trouble in '07, not '08. This is so the warning signs were already there, and we also saw double topped in '07, right? So this crash was foretold. So there's plenty of warning signs to get out. And in going into '08, I actually was, like I said, long gold stocks, right? I was long gold stocks, and they were outperforming. Here we go. We have to go back. They were outperforming the general market because gold was heading higher to 1,000, or it hit 1,000 for the very first time. But an interesting thing happened. Gold stocks really start taking a turn for the worst around here, and I was like, "Ooh, I need to pay attention to what's going on. Something's changed in the market." Um, so I think I managed to lock in maybe like $40,000. It was down from the peak. I think my peak with the gold stocks were 60 grand, right? And what I ended up doing, I started digging deep. There wasn't too much information going on then. It was kind of people were starting to blog, but you still had like Jim Cramer on bloody CNBC just telling you to buy all the time. So it was a very confusing time, especially for a young person. But I started digging around and I kind of saw, like I said, I saw bad omens here in '07 with the housing prices peaking, right? I heard Bear Stearns running into trouble with their book. I saw gold stocks starting to, deteriorate. So, actually, what I ended up doing was I actually quit my job because I had some money in my 401k, and so basically around July, I quit my job to access my 401k, and I basically went short the market. I was starting to buy puts on basically everything related to housing. Anything with potential to go down. I had all the big names: Fannie Mae, Sallie Mae, Lehman, Lennar Housing. I was short China through the FXP, all puts. And so I managed to get in just before the big crash, the September crash, right? I was kind of short by this end of August, middle of August, around here. Perfect time. This is the trade that I should have made like at least $1 million off. I didn't. I didn't not. I made some profits along the way, whereas my P&L was kind of high, but I got shooken out because I was watching the action day to day, tick by tick by this time because it was all over the news. It was everywhere, front page, global meltdown, right? And when you're young, time frames seem to take longer. So like a day trading will be exhausting. 6 hours watching the price action will be exhausting. So I never managed to lock in profits. And I think I made the brutal error of actually thinking this was the actual bottom. I must have saw some charts where the divergence was going positive, and I think I actually switched positive here right at the wrong time. I should have just locked in profits and walked away, or kept a few shorts on. But I was trying to get too cute, and that's just inexperience, right? Um, I actually met a hedge fund manager at a bar one time around this period. He was drinking a little bit, and he was an older guy, and we kind of discussed what his holdings were at the time. He says, and I remember clearly now. He was like, "Yeah, I'm flat." I'm like, "What? This is like the greatest money making opportunity ever." And I was like, "I'm short all the way. I'm making all this money." And he goes, "Yeah, I don't need to get exposed to this." So he's flat, just watching, waiting, and I'm sure he eventually re-entered the market around here after Obama came into office, when there was this kind of plan for stimulus already in the works or being leaked. I'm sure he picked up a few bargains. Well, me, dumbass me, I was already long over here and I was getting wrecked. Yeah, so all my profits dissipated and disappeared. It was a big lesson for me. So I'm actually grateful for it. But look at that. inverse head and shoulders. You know, is a perfect technical bottom, and then even the top, you can draw a head and shoulders if you wanted to. Sure, right, that could be the head. Could have a small right shoulder. That would make perfect sense, and that's a elongated left shoulder. Yeah, and that would have given you at least, at least. Yeah, that's the target for that head and shoulders. So it will give you full warning of where to take profits. You know, yeah, I'm gonna leave it there. My time limit is going up, and I needed some coffee. So, yeah, I'll do a part 2 on this. Because the story that follows is quite fun. So anyway, talk to you in part 2 soon.